We'll figure it out. All right, guys, we're going to get started here in just a second.
We got the technician working already.
There we go. So, you guys meet some good folks, get some good conversations happening. I know I heard some. Awesome stuff. Eric, did you want to share about your deal that you have available? Just even some general information. Have the other folk remember they had a deal.
Yeah, this one is, I was telling Corey, this is not one that's off the market, it's actually on the market. But I have a camp in Golden Meadow, Louisiana. It was hit by both hurricanes, but it survived. We put a new roof on the place, and it's up for sale. I think we have it with Coastal Realty.
So it's on the market.
It's got 2 slips. It's actually on the water, which is nice.
Okay.
It's on Bayou Lafourche, and I think right now we're asking $45,000.
So $45,000, and did you say it was gutted?
We didn't gut it. It did get rain intrusion.
Okay. It's the idea is it's priced for a deal.
It is priced. Yeah, it is priced for a deal, and it's in the flood protection within the gate.
Okay.
Yeah.
Okay, excellent. And so, guys, if any of you have interest for that, get with Eric. All right, so Jack, as you guys saw, so Jack Sternberg's going to be sharing. Jack's currently the president of the New Orleans REIA, but he has a long resume. If you read the info on the meeting tonight, he's got a long resume. You got started doing this yesterday, right?
When men were living in caves.
Oh, yeah.
I did the first
That's it.
cave findings.
Yeah. So Jack's going to come and he's going to share again. Who here has done a note? Can you raise your hand? So like 3, 4, 5, maybe 6 of us. It is one of those things that when I go to REIAs, very few people deal in these, but I promise you it's impacting your investments more than you know. So without further ado, Jack, I believe you're going to introduce your own self.
I'll introduce myself. So
Okay.
I'm Jack Sternberg. I'm going to tell you all about myself in a second. But first, can y'all see that back there? All the way back
So,
there?
hey guys, it's not church.
Come on up.
So he's like, you know what? I have this at dinner. He's like, I have this presentation. I was like, okay, we're going to be on the small TV, itty bitty TV. So if you want to move up, honestly, if you want to bring a chair up too, you can. Just don't be right in front of Jack. That would be awkward.
All right.
But what we're going to do is let him share. If you can't see it, just listen to what he has to say. That works too.
All right, so I'm going to teach y'all some things that hopefully will give you a immediate income. But first, before I start, I want to find out who's in the room. So we all learn differently. We all hear differently. Pay attention. Some of us are smart. Some of us are not. Not to make fun of anybody from Mississippi. Or Arizona. Or West Virginia. Let's just see how teachable you are as a group. So it was once thought that the moon was made of cheese. Very good. Martin Luther King said, I have a dream. Very good. John F. Kennedy said, ask not what your country can do for you, ask what you can do for your country. Very good. The shape of a ball is? Brown. Good. The color of the sky is? Very good. The color of a stop sign is? Very good. The color of a yield sign is?
Red and white.
We're in trouble. All right, so who am I? They call me Obi-Wan Kenobi because I'm usually the oldest guy in the room. Today I'm not, thank goodness. Wayne's here.
Sorry, someone else had to take that title tonight.
I've been an investor since 1977. I wrote a book with a guy named Jeff Watson. Who here knows who Jeff is? right? So
If some of you guys saw me post a video recently about subject 2 from an attorney in the group, that was Jeff Watson.
right. So if you want a copy of this, you can text me your email address right now to 833-5201, area code 504, and I'll send you a copy of our book.
What's that?
Can you
Can
go
you
back?
say it
The
again?
number's
Can't see from here.
504-833-5201. Send me your email address and I'll email you a copy of our book. But basically, it's how to hire your dream team, how to hire the right lawyer, the right accountant, the right manager, all the things necessary to get started. All right, I'm not a public speaker, so we have a lot in common because neither one of us knows what I'm about to say. But I am a real estate and finance guy. I've bought and sold over 1,500 houses, 4,000 apartments, and I've participated in $90 million of private institutional finance. A million square feet of commercial space. This gets me tired to think about it. Retail and office, light industrial, I owned and operated. I've built new houses, remodeled existing houses. I've had a full-service property management company, as well as a mortgage company and a title company. I'm the past publisher of the NoteWorthy newsletter. Who here knows what NoteWorthy is? Anybody? NoteWorthy is the largest and oldest newsletter in the private note secondary market. It's basically the trade association for the private note market. We put on a industry convention each year for the last 35 years. As I said, we're the trade association for the private note business. Today I'm putting together a local group of investors using my training and financial support to buy, sell, and otherwise deal with real estate opportunity transactions. So text me, give me your email, and I'll get you some information on it. So here's how I got started. I got my feet wet by reading a book. I bought 45 houses in my first transaction with one owner after reading a book when I was a student at LSU. I sold the houses because I'd read another book. I just did it. And I offered owner financing on the houses. I took the paper to Wall Street because that's where the money is. And I put an ad in the New York Times, and I put an ad in a brand new newspaper called USA Today back then. And I said, I'm going to be at the Waldorf Astoria on a certain date, certain time. Please come look at my notes on single-family homes in southern Louisiana. Well, there was no buyer there who really write me a check. Not one person. I spent 3 days there trying to sell my notes, and a lot of bozos come by and try and flip them or steal them or just all kinds of stuff. And as I walked out of the hotel, about to go to the airport, I decided I would go downtown rather than to LaGuardia because I was going to go to Wall Street. And I had these notes in a suitcase, in a briefcase. And so I went to Lehman Brothers on Wall Street. I dropped off by the cab in front of Lehman Brothers with my little briefcase full of notes, 45 notes. I went in, I saw the guard, he pulled out this big computer page and he sent me up to the 190th floor or wherever it was to see the head of the real estate department. And so lo and behold, I was sitting in the head of the real estate department of Lehman Brothers, unannounced, and the guy agreed to see me because I'm Jack Sternberg from New Orleans. Well, he went to Tulane. I didn't know him. I still don't know who I saw that day. I went in there. I sat down. We talked a little bit about restaurants and what's in New Orleans and what's this. He said, let me ask you one question, son. What's that? Would Hibernia Bank buy these notes from you? I said, no, sir, they won't. He said, then why would I? Nice to see you. And I was gone. came back to New Orleans, hat in hand, with my notes. And some guy from Southern California responded to an ad. He was a university professor named John Richards, and he operated had a good old boys club that he called NoteWorthy, and it was the NoteWorthy newsletter. So I got introduced to them as a young man, and after John died, his widow called me, and I was fortunate enough to buy NoteWorthy. They financed it on a note, and when I sold it, I financed it on a note. But as a result of dealing at that level in notes, I know basically every note buyer in the country, every institutional, primarily institutional note buyers in the country. So why seller financing? So when lending is plentiful, profits are usually based on buying low and selling high. When lending gets tight, creative financing solutions are the most important ingredient, which is what's happening right now. So, seller financing, there's several areas of seller financing that we're going to talk about today. One is consulting, one is brokering notes, one is manufacturing or creating and owning notes. Those are basically the different areas of seller financing. So, where does the money come from? Well, hedge funds put up money to buy notes. They really do. They don't buy notes on a flow basis. They don't buy them single. Like if you do a deal and you take a $100,000 note back, that note's going to be sold to either a private person or a small institution that will buy those notes. Hedge funds generally don't buy that. Retirement accounts, self-directed retirement accounts, which is private, they buy that. And what they want is yield, and they want alternative investment. Traditional lenders don't buy notes, but they're a traditional source of funds. All right, we call that anxious money. The hedge funds and they're looking to place their money. It's important for them to place their money. 50% of deserving buyers can't qualify in today's market. Would you all agree with that?
I think it's higher.
Higher? So typically, how a deal works is the buyer and the seller go to a mortgage, or the buyer goes to a mortgage company, borrows the money. They get a conventional mortgage. They give it to the seller. In today's market, that's not going to happen. Seller financing, however, the seller becomes the bank. So I heard some of you all talking about doing a bond for deed as a way to sell a piece of property. That's seller financing. That's not really the kind of seller financing that I do. The kind of seller financing that I do is I'll buy a piece of property, sell it to the new owner, and take back a mortgage and a note. We all know what a mortgage is? No?
Death back.
Say again?
Death back.
Yes.
What's the Latin definition of?
Is that what it is?
War.
Death pledge.
Death, and then act
Is that right? I don't know that.
Yeah,
Really?
yeah. It's a death pact.
That makes sense. I don't know why this doesn't work. All right, so seller financing covers, let me give you some examples of what seller financing covers. In older sections of town, we have a store downstairs and an apartment upstairs. That's kind of non-traditional type of property. That's excellent for seller financing. The ultimate buyers of these notes buy them with the idea of refinancing for the customer. I can go into a little bit of that. But over the next 5 years, it's really going to be phenomenal. So a note, the difference between a note and a mortgage, just really quickly, a note is the obligation to pay. So a note spells out the interest rate, the monthly payment, and how long the term. A mortgage secures the note. It's filed at the courthouse. It governs the terms of the loan related to the property. It secures the note to the real estate. So it's two separate things. So when I say I'm in the note business, I'm really in the mortgage business. I buy mortgages. I'll buy notes, but I wouldn't buy them unless they were secured by a mortgage.
Y'all understand that? Any questions about that? Get that?
Jack,
So
I've got one question. Sorry.
all right.
Why a mortgage instead of a bond for deed?
Because a bond for deed is a conditional sale or a type of sale, and the institutions that I sell notes to, they want Fannie Mae note and Fannie Mae mortgage. As close to traditional type of financing as they can get. They don't want a glorified lease option or a contract for deed or a bond for deed, something like that. You can sell them, they'll buy them, but they convert them to a mortgage.
That makes sense.
Basically, they don't want to have to think. They got their cookie cutter. They're comfortable with mortgages and notes, and that's what they want.
They don't want to reinvent the wheel. They want a mortgage. So let me tell you, just real comment, divert from this just for a second, that the institutions that buy notes, they buy them at a discount from face. So if it's a $100,000 note, they might pay, I'm just going to make this up, $90,000 for it, okay? So they have a 10% shortfall, right? They bought it at a discount of 10%. They let it go for a month or two or three, and they solicit the customer and they say, you know, you've been doing so well paying your note, can we refinance it? How much interest are you paying now? And they might say, well, I'm paying 8%. And they'll say, oh, that's great, we can get you a 4% loan, rate and term refinance. And the customer says, great, not only that, we'll put your car loan in it, your student loan in it, your credit cards, refinance all your credit, we'll lend you $110,000 now. So the left hand that bought it from me at $90,000, the right hand lends out $110,000. The institution makes a $10,000 profit on paper right then and there. You see that? Mm-hmm. So they buy these loans from me in order to acquire customers. So they don't buy dead people. They don't buy bad credit. They don't buy people that don't pay their bills. They buy deals that have marginal hiccups. They have certain. They won't buy a note on a pet cemetery, for example, because that's a crazy deal. But they will buy a note on a triplex or a fourplex. Okay, those are readily converted to cash. So that's why the money is virtually unlimited in buying notes, because that's what they do with them. Does that make sense? Have y'all ever been in a closing and you sign a document at the end of the closing that says, if I missed anything, I promise to come back and sign it again? Yeah. Who here knows that? Right? Everyone. The reason that is, they can't force you to come back. And if you don't come back, they don't come looking for you. They wanted you to come back and sign it. Because in the end, at the end of the rainbow, when it gets sold, if it was your money, whose loan would you buy? The loan that's perfectly documented and every single T is crossed and I is dotted, or would you buy the loan where the customer didn't come back and sign those 2 or 3 forms? You buy the good one, not the bad one, right? So that's called scratch and dent. Those aren't fraudulent, there's nothing wrong with them, but they're not perfect. So those loans that are not perfect, scratch and dent loans, are bundled with my perfect loans that I create who have certain hiccups, time on the job, stated income, cash income, that type of thing. And they merge them together and they sell them in a package, sir.
Credit score.
Credit score is important. When you say credit score, what do you mean?
Well, how low will you do it for telefinance?
Well, you can do a seller finance, 550. I can buy a 550 note. Can't give you much money for it, but I can buy one.
So what's your cutoff?
Off of a 550,
No, what's your cutoff score?
what's my cutoff?
Yeah, I mean, if you're looking at a score, let's say 875 would be super and they can go anywhere they want and borrow the money.
Right.
700 would be.
Super. 700 is great. Yeah.
600 would be maybe.
600's maybe. Yeah.
Would you buy a note if they, without a credit score, if they have established a long payment history?
Yes. Alternative credit. Right. Doing a deal right now with a lady who does not have Social Security. She's a resident alien. She's been here for 20 years. And she has a 740 credit score. She has great credit score. She doesn't have a social. That's the customer. Somebody like that who's got an identifiable problem. Identifiable income. Typically, that's the customer. That's who I'm looking for.
So how do you find them?
Well, the way I find them is I find the buyer before I ever find the house. So I advertise looking for people who need financing, I advertise look for people who need me to buy them a house and finance it for them. So they call me, they say, I want a 3-bedroom, 2-bath house on the south side of town, in a certain school district, that kind of thing. I put them with a realtor, send them out. Yeah, that's how I do it. So seller finance helps first-time home buyers, credit-challenged buyers, self-employed people, buyers with limited funds, buyers with a history of bankruptcy or foreclosure for a reason, buyers who have been turned down for a mortgage. You're real estate investors. Some have good income, others are just starting. Some have good credit, some not so good. You could be the customer. So here's how seller finance notes work. There's 2 major profit centers with seller financing. Making the notes, manufacturing the notes, which is what I do. With your own property, this is not right, I'm sorry, or offering a service to consult. So bear with me. Buying notes, I'm sorry. Flipping notes, and owning notes. 4 ways to make money: real estate, consulting fees, manufacturing notes, flipping notes, or investing in notes. So I used to go hunting for notes. Go down to the courthouse and look up who's financing houses for people, go make them an offer. Every single note seller that I've ever talked to, they want 100 cents on the dollar for their note, unless they have a reason. They're not going to take a discount on their note at all. We all agree with that? Sure. They have to have a reason. I only knew of one seller that would take a discount each and every time. You know who that is? Me. I was really good at getting the house at a discount. So I found it was better to manufacture or create the notes myself than it was to go hunting for someone else's property. So about 40 years ago, since I had no money, I began to think about values and how much I could get by selling a note on the property prior to me even owning the property. So the note sale would give me the money to buy the property. Does that make sense? Question about that? Everybody with me? It was reverse thinking. I'm thinking backwards. So here's the process. You got a deal. This is a made-up deal. You're the bank. So here's our deal. 60 cents on the dollar. So it's a $100,000 deal. We're going to buy for $60,000. and we have 40,000 in. I'm not talking about rehab, that has to be plugged in. I'm not talking about market time, that has to be plugged in. This is just for an example. So you're with me. Anybody have a problem with that? No. Isn't that the deal we're all looking for? All right, so we sell the house at a premium. So the sales price of the $100,000 house that's really worth, just between us, $100,000, I'm going to sell for 110 for a 10% premium. I'm going to take 10,000 down, and I'm going to finance the balance of 100, and I'm going to split it into two notes: an $80,000 note and a $20,000. So let's talk about the $80,000 note. So the $80,000 note I'm going to sell. The term of the note, again, this is just made up, is 8.22 rate, 30 years, and the payment's $5.99 a month. So if I want to give someone a 9% yield, I'm solving for the amount that they'll pay me to get a 9% yield. Does that make sense? Everybody understand that? Say if you don't.
Yield and interest are different.
Yield and interest are different. So if I want to offer someone the right to receive $5.99 a month for 30 years and they get a 9% return, how much would they have to pay me for that note with an $80,000 face? The answer is $74,513. All right, so let me go over it again. $74,513. I'll get you 1 second. $74,513. If they wrote me a check for that, and they received 30 years of $5.99 a month, that would be a 9% return to them. Does that make sense?
That's the net present value of that capital.
That's right. That's exactly right. I don't know who said that.
It was Brian. And in the net present value, guys, this is coming from a financial calculator that's, figuring out your yield,
Right.
which is something that we can, do you use the 10B2I?
No, I use
No.
the 12C.
The 12C? Okay.
Yeah, I use the real calculator. But, sir, you had a question?
Yeah, I just didn't see some of the parameters on the slide before this one.
You go back one.
Oh, go back one.
Back one slide, yeah. On the deal slide.
Yeah.
That,
Into two notes. What is that into two notes mean?
so, there's a balance of $100,000.
Right.
I split that into two notes, a first and a second.
Right.
If I sold the whole thing to a buyer, they're going to buy all $100,000 of it at 9%. I would be giving away a lot of money. So I want to split it into a safe ratio, 80 cents on the dollar, right? $80,000 first. So that's a safe amount of money, and I only want to sell that. In this example,
Okay, well,
That's because the buyer wants an 80% ratio to the
the
value.
buyer's not willing to pay, but when the buyer buys the note from me, and you're going to see this in a second, it's going to answer your question.
okay.
But when the buyer buys the note from me, he wants to be safe.
So
Okay?
it's the loan to value.
It's
Similar.
like loan
Yield.
value. It's called investment to
It's the
value.
same risk hedging.
It is. It's called investment to value, not loan to value. It's 80% loan to value. That's true. But when the buyer writes me a $74,000 check for that note, that's called investment to value. So his investment is $74,000. What's the value?
80.
No, 100. So he's in at 74 cents on the dollar for that loan, right? Even though I'm in at 80 cents, he's bought it at 74. Does that make sense? You look puzzled.
It looks like you're taking a loss.
You need to take your mortgage broker hat off. Because it's different. It's reversed from that. It's not the same.
Okay.
When you create an $80,000 first mortgage and they sell it to the government, for example. They pay 81,000 or 82,000. That's how you make money.
Right.
They pay a premium. In my business, they buy it at a discount. So it's opposite. It's different.
Can I say something? When a mortgage company writes a note for $80,000, they give $80,000 to the seller of the property. You wrote that note for $80,000, you only gave $60,000.
You're into the.
No, you're not thinking, you're right, but that's not what I'm talking about. So, I own the property.
You actually made a profit, because you only got 60 grand.
I got 60 grand in this.
In the
You
whole
got 10
property.
down.
Forget that for a second. I've only got 60,000
Right,
in this, and I've sold the first mortgage for 74.
right.
So right now, I've made $14,000.
Right.
Right. But that's a different transaction.
Okay.
That's the real estate transaction, which is different than the note transaction. I know you know something about notes, but I'm just trying to teach them the note.
Introduction.
It's really an introduction to notes. That's all it is.
Okay, I'm sorry.
That's okay, that's okay. So it's different than a mortgage broker. So a mortgage broker, when the bank lends, let me start. When the little old lady standing in line at the bank, give them her $100,000. She gives them her $100,000, they pay her passbook savings or whatever it is she bought, right? 2%, 3%, whatever it is. They take that $100,000 and they lend it out under certain guidelines on a piece of property. And you've got to fit within that box. Credit score, time on the job, rental history, payment history, a lot of things. Got to fit in that box. When they create that note, they go to the federal government and they give that note to the government, and the government gives them a check to pay the little old lady back her money that she put in the bank. And they make a profit. That's why banks have big buildings, because they make a profit on the note. You understand that? So it's different than what we do. But in order to make a profit on the note, you have to fit in that box. You, the customer, has to fit in the box. My customers don't fit in the box. They have an identifiable hiccup. They're not dead. They're not on welfare. They're not bad. They've got an issue, an identifiable issue, like time on the job is the biggest thing, or no tax returns. That's a big thing. It's kind of like a stated loan was, if you all know what that was. All right. So the note buyer is going to give you $74,000 for the note, $74,500 for the note. The second, I created a second, in this case a $20,000 second at 2%, 2% for 30 years, with payments of $73 a month. You might ask, why 2%? Most people would give 17% or 12%, right? Higher than the first. I
And
don't
I'm
do
gonna
that.
want to refinance out of that 2% maybe?
Well, because I charge a premium on the first. My rate's a little high on the first, but I give them a second because the difference between the 2% second and a 10% second is $30 a month. I mean, it's not that much different. And I only keep these for a couple of years, and I encourage them to refinance.
So it's kind of variable interest, but it's breaking down into two terms.
It's
Variable?
Like ARM.
No.
No, it's not normal. So the first is 8.5, or 8.2, whatever it was.
It's all
8.22.
fixed.
It's all fixed, yeah. It's a fixed second, 2% interest. So there's no argument.
You're a nice guy.
I'm a nice guy.
Is the second subservient to the first?
Yes, a second, so behind,
Who's the buyer in the second?
there isn't a buyer in the second.
You keeping it?
You encourage them to refi in a few years.
Yeah, watch. So, so I'm giving them $20,000 second at 2% over 30 years, $73 a month. That's a lunch. We spent more than that at dinner.
Yep.
So it's no money, but it's a psychological. This is the kicker, a balloon in 3 years. Not the first.
So it's
First-
not just a like, oh, let me suggest you go refi. It's like, no, you need to refi in 3 years.
Right. Or if the bank that I sell the first encourages them to refi, they're gonna pay me off, like in 3 months. And I'll get all 20,000, because it won't amortize. So I don't fight them on the second. I don't charge a premium. A lot of these people, a lot of these real estate hucksters tell you, we'll charge them 14%, take it back from them in 6 months. I don't want to do that. I don't want it to stay so. My business is collecting this payment, not
Houses.
houses. Used to be houses, not houses.
So it's almost like you're acting as a bridge for them not qualifying as conventional. They're non-QM. To getting conventional.
It is.
Yeah, to non-qualifying.
It is not.
And then it's a win-win because they get the house and you get the difference.
Yes.
He's
Sir.
not getting the house, which is really important to him. Right.
It's very important to me.
We'll go back to the beginning. You said you got the house at 60% of value. Are you out buying houses?
No. I wouldn't buy a house, like y'all said, up here talking about people, I wouldn't be in that business. Be in that business. Oh, no. I like to stay home.
Okay. How do you negotiate these houses down to?
Okay, so the example, this is purely an example.
Okay.
It is not,
He wants the deal.
yeah. I wouldn't tell you that before, but yeah, no.
Well, what about the example of the deal that I told you at dinner? It's on the market at 155. I negotiated.
Okay.
Would that fit here or no?
Can we talk about that? Let me.
I'll just say I'm happy to share that, but it gives you an idea how, because of seller financing, we can kind of manipulate the numbers some.
I can tell you 5 things you need to change on that deal. I was going to tell you at dinner, but
Okay.
keep on that.
All right. Keep
You
going.
still have time to change it. And
Yep, we haven't closed yet. Happy to talk.
All right. So here's the kicker. On 30-year amortization, it doesn't amortize much. So in 3 years, the balance is 18.5. Okay? Because it's lunch money. There's no money in it. It doesn't amortize. So the note buyer gets a 9% yield, but when the second causes the refinance, the yield goes way up. So here's, again, they paid $74,000 to earn 9% over 30 years with payments of $599 a month, and the balance at the end of 3 years is $77,900, okay, on the $80,000 mortgage, okay? So this time we're going to solve for what yield did they get by putting out $74,500 for 3 years, receiving $599 with that balance. And the answer to that is 10.95. So they basically get an 11% yield by holding it for 3 years. Now, they get 11% over 3 years. Here's what we did. Faster sale, no lender to deal with, virtually no closing costs. Let's talk about the money. How much money did we make? We got $10,000 cash down. We got $74,000 for the sale of the first mortgage, right? For a total of $84,500. We got $73 a month for 36 months for 3 years. That's $2,600. And the balloon payment on the second. Times 36 months is $2,600. So the total is $105,669 profit, less $60,000 to buy the house is $45,000 on a $100,000 house.
So how many,
Because you control the finance. Now, let's talk about some of the questions that you had. Somebody had a question.
Go ahead.
Could you go back to that slide where you took the net present value of the, I think it's 2 slides back?
77,000.
Yeah, 77,000, and you said it was 11% yield?
Let me show you. Right there?
Yeah, so some,
Let's work it in reverse.
yeah.
All right.
You got 15 to 20 minutes, by the way.
Okay. So, they invested 74,000
Right,
to buy an $80,000 note.
right.
All right. The face rate of the note is no, it's not. I'm sorry. It's 8.22. They bought it to yield 9%.
Right.
All right. So now, if it pays out in 3 years rather than 30 years, what are we solving for? What is the return? Putting out 74,000 and getting 3 years worth of $599 payments and the balance at the end of 3 years. The return on that is 10.95.
Okay.
Because they got the money soon. They got the money in 3 years. If they'd have lasted, the longer it went out, the lower that yield would be, all the way down to 9%. If it took 30 years, they would have received 9% return. But because they got it in 3 years, they got almost 11% return. Is that better?
Yeah, so if, anytime you have a balloon note and it's stated for 8%, 30-year amortization, you pay it out 5 years, your effective loan, your effective rate is much higher?
No, because if you had a balloon note at the bank, $100,000 balloon or $80,000 balloon note,
Yeah.
how much would you own in 3 years? Whatever the amortized amount is, right?
Right.
You owe me that too in 3 years, but I've only got 74,000 in an $80,000 note.
Oh, okay.
That's why the yield.
Okay,
Is that?
because you bought it at a discount, I got it.
Right. Bought it at a discount. Ma'am?
How are they refinancing when they have issues?
So I sell, so when you go and borrow money at a bank or buy a house,
Yeah.
the file is this thick, right? The only thing that ever makes it to the vault at the bank is the note and the mortgage. The rest of it is microfilm, putting a thing in Colorado somewhere, in a mountain. So the rest of that's garbage. They don't care about it. But in order to fund that loan, all those documents have to be in order.
Okay.
They all have to be reviewed.
Right.
Right. So that's the, does that make sense to you, or?
There's other non-qualified lenders who will refinance.
Okay, so just another non-qualified lender.
Okay,
And
so,
non-QM, yeah.
so the note buyer of that note, the customer has made 3 or 4 payments, 3 or 4 payments. The documentation to refinance a note versus the documentation to create a note or to fund an original note is substantially less.
Okay.
Substantially less. So this
I was like,
customer,
who
let
would
me
buy it if they
let
wouldn't
me
buy
make
it?
something, I'm gonna make this up. This customer had 1.5 years on the job.
Okay.
Well, to fit in the box, you gotta have 2 years on the job.
Right. So
Well, we
now
all
they-
know if he doesn't get fired, in 6 months, he's gonna have 2 years. And he can get a regular loan,
Right.
right?
I got
So, that's the customer.
And now they have like 3 years paying on the loan, so they're better qualified.
Even 6 months paying.
Yeah, I got you. Okay.
Maybe.
Okay, my first question is, what's the average yield that banks are buying you
Buying these loans for
for? Yeah,
today,
yeah.
like 8 or 9%.
Okay, and then my second question was, how often do you use the second mortgage as a piggyback, or do you have the down payment assistance? You never do that. Have you ever done
So if I did that, I have done that. But if I do that, the first mortgage buyer, the institution, knows that. It's fully disclosed.
Okay,
And they know the customer doesn't have any money.
okay,
And so they're gonna pay me less
okay,
for the note. So I want them to have a down payment.
okay.
But I could use soft second or, any kind of public, state down payment program. Anything you could use, I can use too. Because they're conventional loans. I mean,
They're not made up documents, they're Fannie Mae documents.
Soft second, some of them that I've seen just lately, they're not letting me even do written terms. They aren't lifting their lien, but that's a new changes.
Yeah.
My last question is, do you ever build relationships to prepare them for the refi and kind of like coach them to improve whatever is making them non-qualified?
Yes.
Okay.
Yes.
Okay.
Tell them they've got to get the secondary job. They've got to file. I had a lady, she didn't file taxes. She owned a modeling studio. You know, where you send your daughter to learn how to be a model. And I did a deal just like this. I gave her 3 years, and I told her right from the beginning, she's great, she had good credit, she had tax returns. She couldn't get a loan. I did it, and I said, you got to have 3 years. Do your taxes, so in 3 years you can refinance.
Did she do it?
No. You know, that's the downside.
When you have a backup bank statement lender that you just push her on over
No,
to.
so the truth is, she didn't do her tax returns. And I called, she was a great person. I called her and said, have you done it? Oh, I'm getting to it. She never did it. And come time for the balloon, and the lender she's working with, you all know the name of the lender, and I can't say it, especially on tape, but it was a terrible experience. And they wouldn't close this one. And she had finally got her tax returns, they wouldn't do anything. And I never sold the note, I held the note. I didn't want to sell it, because, you know, I was waiting for her to, I had a home run on the deal. I really got a great deal on the house. And, but it had gone 3 years, and she never missed a deal. And I almost got 92 cents on the dollar for her note. So I told the bank that if you don't close it, like in a week, you're never gonna close it, because I'm just gonna sell the note to the bank. And I was satisfied with 92. And they closed it in a week. Fannie Mae rate return refinance. Any more questions?
Can you discuss if you need a license to be a note buyer or a note seller?
You do not need a license. You have
So
to be
not
the
a
owner of the
MLO?
house.
Okay.
So the way I create these, I have to buy the house. So I own the house.
These are seller financing notes.
And they're self-financing notes. So I can't lend you money to go buy a piece of property. That's not what I do. I don't have a lending license. And I employ licensed mortgage originators to do all the documentation, because I don't want that either. I want it third party. So it's different. I'm not a lender. People think I'm a hard money lender, or that kind of thing. I'm not. I don't do that.
Excellent. And so it's seller financing, but you work it in reverse. So you find the right buyer, they come to you, then you go find the property, get it at a discount, and build the deal from there.
I get it at this much of a discount because my customer pays full price and maybe a little more. No more than 10% over the value. And my customer knows how much the house is because it's in the MLS. They know the house is on the market. But if you need the financing and you want me, I'm like your rich uncle. I'm going to pay cash for the house, you select, and I'll give you 30-year fixed rate financing. Sir?
You mentioned earlier you partner with agents. How do you compensate them for how do you work them in the deal?
Agents in a transaction like this gets 100% commission. They get every penny that they're entitled to, every nickel. I'm not an agent.
So 6%.
Absolutely, 6% for both of them. 3% aside. Yeah, I don't have anything. There's nothing with an agent. That's why they love me.
Jack, have you ever bought or went after non-performing notes specifically and tried to acquire those? Or
I've bought non-performing notes, but there's so much work involved. There's not that kind of work.
Have you ever run into a problem where they've prescribed? Or
Oh, yeah.
Do you happen to, well, I have one that I'm dealing with right now. Actually, rewind 2016-17 at the Shark Tank. It was a St. Rock house. You actually, yeah, you told me about it. 7 years later, I'm still dealing with it. Anyway, it's a issue of whether
Is that
or
the
not.
Music Street house?
Yeah. It's
Okay.
issue of whether or not it's prescribed.
The note?
Yeah.
If they make payments on it, it's not prescribed.
They made payments and then they stopped. They started foreclosure, then they started making payments, and then they stopped making payments. And then the question is, does it start prescription after they stop?
It interrupts prescription. If they make a payment, it interrupts prescription.
And if they stop making, once they stop making payments again, do they have?
Again.
It starts again. Gotcha. Okay.
Can you describe what happens if someone doesn't make payments to you? You have to go. You go after the.
I don't like that. I used to be a big foreclosure buyer. I'd go to the auction every week and find. I do these to stay sold. I don't want them back. But if they don't make the payments, they're going to lose the property.
You're gonna find another buyer.
Right. But bear in mind, these houses, I take orders for houses. I don't speculate on houses. Used to, I'd buy a house, fix it up, paint the inside this color, and some old lady would walk in and go, "Oh, I hate that color," and she'd leave it. And so I decided I'd start painting the house, whatever color she wanted, go pick it out, and I'll go buy it. So I started doing it in reverse, took all the risk out.
You learned that from a book, you said, or?
No, this is from the School of Hard Knocks. Yeah, this is from the School of Hard Knocks.
What was the biggest obstacle you had with non-performing notes?
Well, the non-performing business is a completely different business.
Okay.
So if you buy a note that's non-performing, it may not be properly secure. I bought a non-performing note one time. This is so long ago. I bought a non-performing second on a house in my subdivision. And it was, I think it was $15,000, something like that for a second. And I bought the second, and I'm sitting there reading the paper a couple days later, and I see the thing, and it's going to foreclosure. I knew it wasn't paying, but it's going to foreclosure. That's the one I just bought. How could that be? So I go to the courthouse, to the auction, and sure enough, it's going to foreclosure. Well, I got the second right here, I'm gonna get paid off, right?
Maybe.
Yeah, no. I bought lot 12, subdivision, whatever it was. It was a typographical error. It was lot 21. So the note I bought wasn't even secured on that house. So what I did was, I was very aggressive in my younger days. What I did was, I ran downstairs to the courthouse and I filed a notarial act of correction. After the sheriff gavelled it sold at the auction, I ran downstairs, filed a notarial act of correction, converting it back to what it should have been, which was lot 12. They went nuts because my second slid into second place right then, and they hadn't issued the title yet. Somebody else had it, right? So all of a sudden, my second became a first because when they sell it at the auction, they cancel the first. Well, now I have the first. They went crazy. That cost $10,000 legal fees, and I lost. But
you made your point.
I have to tell the story. I lost, I think it was 12 or 15 on the note, and 10 in legal fees. So I would encourage you not to do that. Any other questions?
So we've got 5 minutes left. Any questions for Jack? Has this opened y'all's eyes?
Yeah.
Can you explain how big the note industry is? You were mentioning earlier you used to do the conferences. How many people would you have attend?
700.
Okay.
It is a growth after you learn to buy and sell houses, after you dabble in a little commercial. People think it's a natural next step.
Progression.
Progression.
Become the bank.
Become the bank. So, you know, it's a huge, huge business, but it's there are only a few lenders in the country that'll buy this paper. You can't go to the bank downtown and get them to buy it. They won't buy it.
Like Hibernian.
You can't go to
like
Hibernian. They don't exist.
They don't exist. They're not there no more.
But, so, there's specialized institutions that buy these notes.
And you buy them.
Absolutely.
So you're still, okay, so.
Yeah, I'm very active.
So you're still actively buying
Oh,
notes?
yeah. So I'm doing deals now with partners, students. I'm doing a deal in Boston right this minute. Doing a deal with Little Rock.
Can I ask a question? So New Orleans, so Louisiana,
Fantastic.
so you do deals here.
Yeah.
But right now, obviously, insurance is hurting.
That's not my problem.
It's not your problem. But
I'm
here's
out of that business. I don't care what insurance.
Right, but so one of the reasons I wanted to bring this topic here was because I know all of us are struggling with the rising cost of repairs, the rising cost, the hot market where houses, it's hard to get the discounts on houses. Insurance is up, skyrocketed, property taxes are going up. But if you remove that, your yield, you're then able to have these yields, right? I'm not saying that there's a long-standing debate between property and paper. So the words mortgage, notes, paper, they're all kind of out there. There's always been that long-standing debate between property or paper. And this is not really what I'm wanting to get into as far as that debate, but it's the idea here. I've heard people saying, man, I have rentals. I'm thinking of getting out of the rental business because of all the craziness. And so one of the things they've been doing is selling their rentals for paper. So selling their properties on seller financing. I'm dealing with a few portfolios right now in the greater New Orleans area. They're wanting to get out of the rental business maybe because COVID beat them up, or they don't like the landlord-renter mindset, conversation these days, or whatever, right?
I'm not kidding you, I had 1,500 houses at one time and 40 employees. And when it froze outside, it cost me $100,000 because pipes would burst all over town, my pipes, I don't have that problem. I would wish that's not what you want. I know that's what you're
So it's a different perspective.
But that's not what you want.
But it's a different perspective, right? And there's different strokes for different folks as far as the different ways. There's 100 different ways you can spend time and make money in real estate. So this is one of them, right? So any final statements you want to share? Anything? Because this is an introduction, right? How many of you guys felt like you learned something you can take away, right? It's an introduction to the note world. This should not be your only training.
Yeah.
We need to say that.
Yeah.
But with that being said, any other final thoughts?
So when I look at something, I look at the disposition of it in advance. I don't buy equity anymore.
Somebody needs to
I look at what I can get for it, how it would pay for out. I wouldn't buy it on speculation. It's not to say that's a bad thing.
You're buying it for what you're buying it with the mind of what your buyer will pay for it versus just, this is a good deal.
If I ran in the circle, I'm president of a club in New Orleans. I get exposed to deals all day long, like you and whatever. I'm not in that business anymore. I don't want that. I want the buyer who said, that's the house I want, with that kind of wallpaper. And if he likes it, I like it. I don't renovate houses. I own more caulk guns than anybody in America. But if I had to get one right now, I'd have to go to Home Depot and buy one. But I bought more than anybody. I don't have that problem either. So I'm a jaded landlord, to say.
Excellent. All right, guys. Sure you want to give any of these out? I can give them out.
Give it there.
All right, guys. So I know that you were asking some great questions, and Sabrina as well. So would you like to pick one?
Okay,
Getting past no and the E-Myth manager.
can you get me past now?
There you go.
Thank you.
All right. Who here has employees? You read? E-Myth? Michael Gerber. I almost never remember or am good at asking those questions, but guys, so Jack here, look, he's local. He has been doing this for a long time. When I was looking at bringing someone in to talk about notes, I said, I wanted to kind of bring someone in who's in our area, who's doing this, but also someone who's experienced. But hey, maybe some of you say, hey, Courtney, this was kind of, go back and watch it. You're welcome. It was, so you can go back and kind of slow down the speed, check it out. But again, don't let this be your first and only introduction. Let this be something you build upon. If you're interested in, as a creative real estate investor, for example, you mentioned all the different ways you can make money. I could create seller finance notes with the seller that I'm dealing with, and then orchestrate an opportunity for them to get paid out in one chunk. But it gets me good financing, right? Like there's various different ways that this can kind of be played with. So tonight we're gonna go head on over to the Chimes at 8:45. So it's just right down the way. If you need some information about some vendors, there's the cards outside. And then next month, you can see the rest of the meetups over here. Go to CourtneyTinK.com. It has all the details of the next meetup. But then October 11th, we're going to have information on buying at the foreclosure auction is going to be next month. And St. Tammany Parish is going to come, and they're going to break it down. Again, they're the gold standard. So thank you guys so much for coming out. And